Hello, everyone, and thank you so much for attending week 2 of BFSG's 4-part summer webinar series in 2022. Today, touching on retirement plan basics. So again, my name is Chad Narani, a retirement plan consultant here at BFSG, mostly just playing host and moderator for today's chat box, Q&A box, etc. I also have two colleagues on the line, Keith Johnson and Tina Schackman. Keith, do you want to take a moment to introduce yourself?
Great, thanks, Chad. Yes, again, my name is Keith Johnson. I am a senior education specialist and financial planner with Benefit Financial Services Group. So essentially what I do is help retirement plan participants with investment management guidance, planning for retirement, as well as various other financial planning needs. Thanks, Chad.
Yeah, and Tina.
Hello, everyone. My name is Tina Schackman. I am a senior retirement plan consultant and a certified financial planner professional. And I work mostly with employers to help with designing their retirement plan, as well as overseeing the investments and providing participant education like we're doing here today.
Thanks, Tina. So yeah, this is a sweet spot for Tina, this topic today. Really talking through the basics of just running a retirement plan, 401k, 403b, 457 plans, like any type of those defined contribution retirement plans is what we're talking about today. With that, let me give it back over to Tina to kick us off today.
You got it. So let's go through the agenda. Today, we are going to answer 5 key questions that we get from a lot of employees. The first is, why should I save my employer's retirement plan? And then, how do I enroll? How much should I save? How do I invest my money? And then finally, how do I get my money out? So we'll cover all of these. But again, as Chad had mentioned, if you have anything else that comes up, please feel free to ask. So we are going to kick it off with a poll question. We just want to get an understanding of how many of you are currently enrolled in your employer's retirement plan.
Everyone, so with that, for all of you that are unfamiliar, that should have popped up in your Zoom window. Again, poll number 1, we have 2 interactive polls today, so there will be another one later in today's presentation. Just let us know, are you enrolled? Yes or no? Quick, easy. I think with most people having already responded, I think we can actually already close this poll out, guys, after only 20 seconds. Let me end the poll and I will share results with the group. This is awesome to see, by the way. About 89% of people on this call say that yes, they are enrolled. The other 11%, hopefully at the end of today's discussion, you have all the reasons that you want to enroll and save for retirement as well. Thanks, Tina.
Thank you, Tina. That's great to hear. I can't emphasize enough the importance of taking advantage of your employer-sponsored plan just to ensure you build that solid retirement foundation going forward. And just as a side note, so this is great because nationally, the average is about 65% of eligible workers in the US contribute to their employer-sponsored plan. So we're way ahead of the curve here, so that's good. So let's talk basics here. Why even save in your employer's retirement plan? With life expectancy increasing, some workers may spend more time in retirement than actually during their working years. Also, Social Security is not just going to cut it on its own. So investing in your plan, it's very easy. What happens is your employer automatically deducts your contributions every time you're paid. So you don't have to essentially remind yourself to write a check. And once this becomes a habit, most people don't even miss the money coming out. So you could potentially receive matching contributions. This is something you would need to check with your employer on. And whether you invest on a pre-tax basis or an after-tax basis, like in the Roth 401k, 457 or 403b option, there can be significant tax breaks. So additional benefits include cost-effective investing for larger plans, fees are low, professionally managed portfolios and investment options, and also creditor protection. Another reason it makes sense to invest in your employer retirement plan is retirement may be unexpected. This is predominant in this country. The most recent reports are consistent with prior years. The median retirement age among retirees is 62 years old, while workers' median expected retirement age is 65. The past couple of years have caused about 1 in 4 workers to adjust the age at which they plan to retire. Also, this survey continues to demonstrate that nearly half of retirees retire earlier than expected, most often because of like a health problem or something to that effect, or because of changes right in their organization. So let's talk a little bit about life expectancy. It's estimated that more than 70% of the wealth in this country is controlled by the baby boomers. Their number one fear as they transition into retirement is what? Outliving their income. So because we're living longer in the US, longevity plays a key role when we talk about planning for retirement. There's a resource here for you. It's a great website. If you go to visit this, it's livingto100.com. Maybe Chad, you can drop that in the chat there. So essentially what this is, it has a life expectancy calculator. It's a great resource. I'd recommend checking it out. The calculator, it'll ask you 40 questions related to your health, your family history. It takes about 10 minutes to complete. And from what I understand, it's going to tell you the exact day you're going to die. I'm kidding. That's a joke. But it's a great resource for living longer in this country, and I would recommend checking out this site. So I talked a little bit earlier about Social Security and loan. It's just not going to cut it in retirement. The average Social Security benefit in this country is about $1,600 per month. Again, confirming the importance of taking control of your own retirement to ensure you want to live that lifestyle that you anticipate throughout your golden years. Another reason not to rely exclusively on Social Security, the last 11 trustee reports have indicated that Social Security's trust fund, the reserves within that trust fund, could be depleted by the year 2033 until 2035. So if there is no legislative change enacted, scheduled tax revenues, they're going to be insufficient to pay. So your benefit could be reduced to about 3/4 of what you expected. So that's kind of to be continued on that front. And at this point, I will turn it over to Tina to talk about how to enroll in your plan.
Great. Thank you, Keith. So every retirement plan has its own design. Employers can choose when they want employees to become eligible. There can be different methods for enrolling in the plan, and they can also make decisions of whether they want to make any contributions into the plan on your behalf. So if we take a look at eligibility, and we put these terms up here so you can get familiar with them, because these are very specific to retirement plans. But eligibility basically means when you're eligible to become to join the plan, and it can range from age. Typically, plans will require you to be 21 years old. There might be a tenure, so they may require you to be employed for 90 days or maybe even a year. There's also a difference between whether you're a full-time or a part-time employee. Most plans will have full-time employees eligible to participate in the plan. Some do allow part-time. There has been recent regulations that require employers who have employees that worked 500 hours for 3 consecutive years to become eligible to join the plan. And then there's also when you enter the plan. So this could depend on payroll timing. An example would be if you got hired in the middle of the month and their entry date is the first day of the month following. So you may not actually have your payroll deduction until a couple of payrolls. So there may be some slight delays. We do get lots of questions about, I joined the plan, but nothing's been taken out of my check. And a lot of times it just has to do with when the entry date is and when your payroll timing is. There are 2 ways that you can enroll into the plan. Back in 2006, the Pension Protection Act was passed, and it made it easier for employees to automatically enroll employees into the plan. Now, approximately 50% of retirement plans have established an automatic enrollment feature. So basically what happens is when you're hired, you're automatically enrolled into the plan. And typically it can be a certain number of days. Usually it's 90 days after your date of hire. And you'll go into the plan at a specified contribution rate. And that could be, for example, 3%. So 3% of your salary would come out of your paycheck and deposited automatically into the plan. And your account would also be invested into what's called the default fund. This could be a balanced fund or a target date fund, and we'll discuss investment options a bit later. But those decisions are going to be made for you if you have a plan that has set up an automatic enrollment feature. And if you do get automatically enrolled, and let's say you didn't want to join the plan at this time, you always have the option to opt out of it or reduce your contribution rate to 0. So you're not locked in if they have that feature. The other half of the retirement plans that don't have automatic enrollment basically require their employees to manually enroll in the plan. And that can typically be done through the retirement plan provider's website. There could be an enrollment form that you can obtain through your HR department, or you can call the provider service center and speak with a representative. And at the time of enrollment, you will need to select how much you want to contribute into the plan, and then what type of investments or how you want your account allocated. So you would need to make those decisions on your own if you're manually enrolling in a plan. And then if we take a look at the contributions, so there are limits. The Department of Labor is the regulatory body that oversees the operations of retirement plans, and they've imposed limits on how much you can contribute into the plan. So if you're under the age of 50, you can put $20,500 this year into the plan. These do get adjusted on an annual basis. If you're age 50 and over, you actually can contribute an additional $6,500 for a total of $27,000 into the plan. And again, this year. And there's two different types of contributions you can make. There's pre-tax and Roth. And we'll go into those a little deeper on the next pages. But also looking at your employer contributions. So employers have an option, it's not required, but they can make matching contributions on your behalf. So in a matching contribution, for example, let's say your employer decides they want to contribute 50% up to 6% of your contribution. So an example, if you contribute 6%, your employer will contribute an additional 3%, which is 50% of 6. And that's a 50% return on your investment right out of the gate. So we always encourage employees to contribute at least up to the employer match if they can, because it's a great way to really increase your retirement savings. One thing to note for employer matching contributions, those are always made in pre-tax dollars. So when we go into the pre-tax and the Roth, I just wanted to make that clarification. We do get that question sometimes where the employee is making Roth contributions and they want their employer to do the same. And at this point, that's not possible. That's a requirement that they have to make them on a pre-tax basis. Some plans may prefer to make profit sharing contributions, which is really not tied to how much you're contributing, but more your proportion of the profits of the company. And these types of contributions are typically made annually. But you can, when you read, all plans have what's called a summary plan description. We call it an SPD. You have access to that. So if you were to get that type of document, you could go through and see what all the features that we're talking about here is all laid out for you. So you know what your employer is currently offering as far as matching contributions. And then finally, we look at vesting. So your contributions and all of your earnings are always 100% vested, which means they're always yours to take. The employer contributions may have a vesting schedule. Now this can vary. Some employers may have 100% vesting upon hire, so that you don't have to worry about waiting after a certain specified number of years before you are able to take all of those, all of the employer contributions. But the vesting schedule here, we have an example. This is what's called a 5-year tiered vesting schedule. So basically what would happen is if you stayed with your employer for 2 years and you were to leave, you would only get 40% of what they contributed into your plan. You could take 100% of yours, but you would only get 40% of theirs. So that's important, because you'll see on your statements, you'll see what your account balance is, and then you'll see what your vested account balance is, and that's because there's a vesting schedule to the employer contributions.
And just to kind of something we didn't identify here, like Tina said, every single one of these plans they're a little bit different. They have their nuances. One thing that is consistent across the board is if you're not enrolled, or even if you're currently enrolled, listing the beneficiaries on these accounts is paramount. It's so important because these assets pass by what's called operation of contract. So whoever you have listed, written name on there, that's where the money's going. You want to make sure if you have a life-changing event or anything like that to absolutely update that information. Just wanted to add that.
Yep, and that's a great point, especially if you're automatically enrolled in the plan, you have to go and actually manually put who your beneficiary is. So,
yep,
great point.
Okay.
All right, well, let's break down the pre-tax and the Roth contributions. So looking at pre-tax, these types of contributions are what are called tax deductible, which means that the contributions that you make into the plan will reduce your taxable income, and it'll reduce basically the amount of federal taxes that you would pay for that year. So you don't pay taxes until you're ready to take your money out. And your earnings will compound on a tax deferred basis because they're able to grow without being taxed until you start withdrawing your money. And then once you start withdrawing from the plan, you will pay your income taxes on the amount that you withdraw, and any withdrawals, and this is important, any withdrawals that you make prior to age 59 and a half may be subject to a 10% early withdrawal penalty. So it's very important to try and keep your monies into the plan until that age. Typically, you would prefer to make pre-tax contributions if you think that your tax rate is going to be lower in retirement. If you're a high earner right now, pre-tax could be more appealing because it's going to reduce your taxable income. And then if we switch gears and we look at Roth contributions, they're basically the opposite of what I just said for pre-tax. So Roth contributions are made after you pay taxes and they're not tax deductible. However, if you make at least 5 years of Roth contributions and you're at least 59 and a half, you can withdraw these funds without paying any income tax. So you would want to consider Roth if you believe that tax rates at retirement will be higher, because you can pay your taxes now at a lower rate. Or typically we see younger employees that have a much longer runway to retirement, where they're not quite making, they're not in their high earning years. They may favor Roth early on. And then finally, there is an exemption to the income limit. So if you were to contribute in a Roth IRA, which is outside of the 401k for retirement plan, there are income limits. If you make a certain amount of income, you can't make those contributions. So that doesn't apply in the retirement plan. So it's a nice feature, but you'd want to check with your your employer to make sure that it's offered.
Yep. Yeah, and the contribution limits are much higher, so there are quite a few benefits to exploring this option inside your plan. Okay, so let's talk a little bit about how much you should be saving. Well, that's kind of an it depends answer. As a rule of thumb, you should always contribute the minimum to take advantage of, Tina mentioned this, to any potential employer match. And in a perfect world, at least 20% of your income should go towards savings. Meanwhile, another 50%, this should kind of be like the maximum, should go towards necessities, while 30% goes towards any discretionary spending you may have in your lifestyle. So this is called the 50-30-20 rule of thumb, and it provides kind of a quick and easy way for you to budget your money. So how should you invest inside of your employer-sponsored retirement plan? So as you begin to invest, it's important to build a diversified portfolio or make sure you're not putting all of your eggs in one basket, so to speak. You'll typically want to own stocks, bonds, and cash in your account. So in practical terms, this is diversification, and diversification is holding investments which will react differently to the same market or economic event. For instance, when the economy is growing, stocks tend to outperform bonds, but when things slow down, bonds often hang on better than stocks. So by holding both bonds, stocks, you'll reduce your chances of your portfolio taking more of a hit, essentially, when the markets swing one way or another. So when you invest in a mix of different types of investments, you are diversifying. So diversification means lowering your risk by spreading money across and within different asset classes, again, such as stocks, bonds, and cash, it's one of the best ways to weather market ups and downs and maintain that potential for growth. So here's a chart stemming back to the year 2007 through 2021. So each one of these shades represent a given asset class or investment style, and they're ranked from top performing to worst year over year. As you can see, there is frequent change in leadership year over year. So take, for example, if we look in the year 2017. In 2017, emerging markets happened to be the #1 performer over any other asset class. Then we fast forward to the year 2018. What happens? Emerging markets go from first to worst. No one, not Tina, Chad, myself, anyone can say which asset class is going to be the #1 performer next year. So that's why it's so important to diversify your assets across all of these different investment options. Also, when you do this, that's where more than 90% of your returns are derived from. And you'll see the middle line here talking about asset allocation. Chad, you do a pretty good job of explaining this. Anything to add here, or did I hit on everything?
Yeah, I mean, I think the easiest thing to do here, it's what I typically do on this slide, is it's really a plug for actually the webinar we're doing next week on behavioral finance. Is that asset allocation box, you'll notice it's always in the middle, right? And the idea here is if you think all the way back to the far left of this chart, global financial crisis, for any of you that remember it, right? It was a scary time for a lot of people, right? It's in a lot of the stock market was down. If you think 40% in just 2008 alone, at the market trough was actually down 50%. That means if you had $100,000 at the low of the market, if you did nothing, 100% stocks, you had $50,000 at one point. That's really scary for a lot of people, especially those getting close to retirement. Now, what really happened is within 4 years, the market fully recovered. But a lot of people had gotten scared out. Maybe they lost $40,000, sold out, went to cash, and 4 years later, still only had $60,000 sitting in cash because they didn't stay the course. And so I think behavioral finance is remarkably important on this slide, knowing your risk tolerance for investing to make sure that you kind of are able to stay invested for the long haul and get to retirement and through retirement overall. Thanks, Keith.
Thanks, Chad. Okay, I'll turn it back over to Tina. She's going to talk about asset allocation and tools inside of your employer-sponsored plans.
Great. Well, and it was what I mentioned earlier about enrolling in the plan, where if they had automatic enrollment, typically what plans will offer is what's called target date funds. And that would be the actual fund that you would be defaulted into if you didn't make any selection. So there's really 3 primary asset allocation tools that are typically found in retirement plans. And as I'd mentioned, the target date funds, how this works is if you had intended to retire in the year 2040, you could invest in the target date 2040 fund, and the allocation would become more conservative as 2040 approaches. So it's basically a set it and forget it type of strategy. Now, some retirement plans will offer asset allocation models, and this is designed to assist you with getting into the appropriate asset allocation mix using the underlying funds in the plan. Now, there can be static models, which are where they don't change over time. So the allocation is set and they stay that way. Or there can be more tactical, which is where they may change based on market conditions. And then there's also managed accounts. And while the first 2 options I discussed usually don't have any additional expenses above the expense ratios or the expenses of the investment options, managed accounts will have an additional fee for the service. And that service will include a customized allocation based on your personal situation, and it'll update as your needs or goals change. It's a much more interactive solution that does require more input on your part to ensure that you're really getting the full benefit of a professionally managed account service. Now, not all plans have these solutions, but we typically find that at least one of them is available in the plan. And then within these asset allocation models, if we talk about managing your risk, there usually are what's called a rebalancing feature. So what that does is helps your portfolio stay with that target allocation that it was designed to, despite what the markets might do over longer periods of time. So something that we've noticed up until the end of last year was many investors were getting over allocated to equities or stocks because the stock market had been performing so well. But when the market gets volatile, they could end up selling them at the wrong time because they're not comfortable with the risk of that portfolio. So it's very important to assess your portfolio risk on a regular basis. But here's kind of an example of how rebalancing works. So let's say that you sign up for a portfolio that has 70% invested in stocks and 30% in bonds. And at the end of the year, stocks outperform bonds. Now your allocation shifted to 80% stocks and 20% bonds. So that's not what you signed up for. And in fact, it could be potentially outside of your tolerance for investing in stocks, which is kind of what we started seeing quite a bit of. So many plans will have an automatic rebalancing feature, and you can set this up so that it'll adjust accordingly and keep your allocation to that target that's most appropriate for you.
I think that's, you could argue, almost probably more important now than almost ever before with these markets being so volatile right now. Thanks, Tina. So once you've built your diversified portfolio, we talked about that, and you're rebalancing like Tina was just speaking about, so important to stay the course. No one has a crystal ball. For example, inflation right now is at about a 40-year high. So that's really hard to predict something like that happening. Either way, the last time inflation was around 10% was in February of 1979. So back then, a suffering economy and a volatile market added to investors' anxiety. So this graph illustrates the 5 different choices an investor could have made during that time frame, while the seemingly safer investment choices like bonds, cash, gold, that may have provided temporary relief, they fell way behind over the long term versus the investor who stayed in the balanced portfolio or stayed invested in the stock market. We just don't know what will happen in the future. So either Tina, Chad, anything to add here?
No,
yeah,
I think go ahead.
I mean, I love this slide. It's an amazing slide to show. I think that probably the one just word of caution. I think if you look at this slide, you say, well, let me just put all my money in stocks, right? They went from 10,000 to 1.5 million. That's almost triple anything else on this page. And I still would caution against that, right? It's that stock chart. If you notice towards the middle, which is the tech bubble and the financial crisis, did have periods where it came back almost to where the bond portfolio was until the most recent bull market. So I think word of caution, understand your risk tolerance. I cannot stress that enough. I know Keith and Tina will harp on this over and over and over again, but knowing how much risk you can tolerate to take in your portfolio, especially as you get closer to retirement, right? Scaling down those stocks, adding more fixed income as you get closer to retirement, just to make your portfolio a little bit stronger ballast for your retirement.
Yep, great. Thanks, Chad. Okay, so let's kind of tie this together. So what does retirement security mean to you? Obviously, taking care of your essential expenses for as long as you live, as well as providing for your family and loved ones. And for many of us, you'll probably want to have enough saved so you can actually enjoy your retirement. So have you thought about what you'd like to do once you go to retire? I ask because a typical retiree right now watches about 48 hours of TV per week. I work with a lot of folks. Financially, they're ready to retire. They're ready to go, but they have no idea how they're going to spend their time. Not having a purpose, that can be a recipe for disaster. So it's really important to think about that aspect as well. And at this point, what I'm going to do, turn it back over. I think we have another poll here that kind of addresses this.
We do, Keith. So I did just launch it again. So for all of you on Zoom on the computer, you should have seen a poll jump on your screen, and it's an easy question. What do you want to do in retirement? And obviously we can't have every single option, so there might be some things missing, but I think the idea here is just add as many as you can. Like, what are the things you would love to do when you have no work, right? I think most of us spend somewhere between 40 and 80 hours working per week. That's a lot of time you're going to get back. What type of hobbies would you like to do in the retirement? Most are in. Let me close polling and let me share results. This is good. So basically really low percentages for a few things, like 3% sleeping in, catching up on my reading, consulting or starting a second career. The biggest one, over 50% of people saying just traveling, right? Or, 7% saying playing with my grandchildren. And very few people say, I don't want to do anything. Like, I don't know, that sounds pretty nice. Just sitting on the couch or sitting at the beach by the pool would be pretty nice retirement, at least for, a few weeks or so, but I might get bored too. With that, let me stop sharing results. I'll give it back to Keith and Tina.
I'm surprised no one said tracing my genealogy because my sister just retired and that's what she's doing. So there might be one or two.
I spoke with a participant yesterday. That's exactly what she's going to be doing too, which is crazy. So that's a good option on there. But the travel piece, that can be a significant amount of your budget in retirement. So it's always important. Yeah, I want to travel, but putting pen to paper, how many trips per year, how much will this cost? Because these withdrawals, especially with everything going on right now, that can have an impact on your overall retirement. So it's really important. I love it getting out there and traveling again, but it's really important to budget for that as well. So.
I think Keith, to add to that before you go, because I think you'll address it too, is especially when travel is something you tend to do early in retirement, right? Not later in retirement, because later in retirement, as you start to age, it becomes harder and harder to travel. And so that does mean you're pulling more resources from your retirement nest egg early on in retirement, which means it doesn't have time to continue growing for later years in retirement. So really big to plan that out way earlier in your career to make sure you're saving enough.
That's great point, actually. And regardless of what you actually want to do in retirement, when you retire, that can have a long-term impact on your retirement security. So imagine, like we're seeing right now, if you retire right before a major downturn, even if you've done everything right when it comes to saving, investing, diversification, rebalancing, staying the course, if you're unlucky enough to retire right before a major downturn, this could potentially increase your risk of running out of money because of taking withdrawals during the declining market. That can have an adverse impact or effect. So it's really important to plan for these scenarios if you're in that situation. And this risk, it's even greater if you invest too aggressively. I do speak with some folks, that maybe they haven't saved throughout their career and they're wanting to be more aggressive as you near or enter retirement. When you're younger, totally fine. You can take on more risk because what? You have more time to recover from market losses. But later on, you have less time to make up for that lost ground, so to speak. So in an uncertain world, developing and following and sticking with the plan, running these scenarios, that is all key. So what if you've been a good saver? So maybe you have more than just your employer plan. If you own more than one retirement account, whether it's a 401, 457, 403B, IRA, Roth IRA, which do you take from first when you go to retire? So this is kind of a general rule of thumb here. The general rule of thumb would suggest you defer paying taxes for as long as possible. So you would first take withdrawals from your taxable accounts. Then if you still need more income to supplement Social Security, pensions, you would move on to taking withdrawals or distributions from your tax deferred accounts. And only when those accounts have been exhausted would you take withdrawals from your Roth assets. Because what we're trying to do here is allow those to grow. Again, Tina mentioned this, they grow tax-free. Want to do that for as long as possible. And again, Roths are unique in that you don't have to take those required minimum distributions if you don't need the money. So this is very versatile in cash flow and retirement and could ultimately result in what would be a tax-free benefit to your beneficiaries and heirs. So it's a pretty powerful tool. And so there's some strategy there. At this point, I'm going to turn it back over to Tina to talk about some of the logistics and options of actually accessing your money held in your employer plan.
Great. Well, now that we've kind of covered how to save and invest in the plan, we do get a lot of questions from folks trying to figure out when they can take their money out and how they can take their money out. So we'll go into two different scenarios here. One is during employment and then after employment. So during employment, most plans will allow you to take out a loan, but not all the plans allow this. So you definitely want to make sure that you ask your HR department or you check that summary plan description first. Now, a loan can be taken in the amount of the lesser of 50% of your vested account balance for $50,000. And you'll pay the loan back into your account through payroll deductions on an after-tax basis plus interest. So while it may be easier to take a loan from your retirement plan than a lender because you don't need a credit approval, there are some downsides because you may need to pay it all back if you leave the company, or if you default on the loan, you're not making the payments, it'll become taxable income to you. So we definitely suggest speaking with a representative or an advisor before taking a loan out of the plan. In the event that you have an unforeseen emergency or you've suffered a hardship, some plans will allow you to take withdrawals out prior to 59.5 without a penalty. There's not limitations on the amount, but they usually have to go through some approval process. These types of withdrawals would be added to your taxable income in the year that you took the withdrawal out. And then lastly, some plans will also allow to take in-service withdrawals. So if you are at least 59.5, you could take out a withdrawal, you could roll it into an IRA or use the money. If you rolled it over into another type of retirement vehicle like an IRA, it's not taxable, but if you took it out and used it, it would become income to you. And then if you leave your employer or you're set to retire, there's usually a few options here for you to consider. The first is taking out a lump sum. In this case, you'll pay taxes on that amount and you would lose the ability to continue deferring taxes on the account if it's in pre-tax money. Now, if it's Roth money, you can take it out, not pay any taxes. We typically don't recommend this type of this course of action unless there's really an immediate need for the money. But there are some plans that would allow you to take out a partial payment. So you could take a one-time distribution and leave the balance in the plan. Another option for you is to roll your account into your new employer's plan. So this is called a direct rollover, and you can typically work with the new service provider, your new retirement plan record keeper, to get the appropriate forms for this. But you'll want to compare your current plan and your new plan for costs and investments, because it may make sense for you to leave your account at your previous employer if the plan has more assets, it's a larger plan, and they've been able to negotiate lower fees. So you definitely want to have some comparison there. The other option is to roll into an IRA. If you're already working with an advisor or you're comfortable making your own decisions, this can certainly be a good option for you. And then finally, some plans do allow you to set up systematic installment payments. So you can create a regular income stream similar to what you were used to during your working years when you're getting a regular paycheck. So those are really the most common ways to get money out of your plan. But we do get some questions. I got a question actually last week. Someone asked, if I left my employer, do I lose all of my money? And the answer is no. The money that you put into that plan is always yours. And again, it's 100% vested. What you may give up is if the employer contributions have a vesting schedule and you didn't reach that 100% mark. But if you leave your employer, you can certainly take your money or leave it there. You have certainly a lot of flexibility.
Exactly. Yeah, if you're moving from a previous employer, you don't have to take that money out until required minimum distribution age, which is 72 this year. So you have a lot of flexibility in this day and age. With that being said, I know this has been a lot of information. So just some key takeaways here. There is no one size fits all strategy. There's no single best way to withdraw from your accounts for everyone. That's an it depends answer. And retirement planning, this is a whole goal or objective here. It's never finished. So it's constantly measuring your progress and success. Should be done on an ongoing basis with a fiduciary advisor and someone to help you along the way. So with that being said, we are actually here to help. Times are uncertain right now. The markets are volatile, and we can kind of help you guide through all of this. So this is our team of experienced financial planners. We all hold the certified financial planner designation and act in a fiduciary capacity. So this means we always put our participants' interests first by law. We don't sell any financial products or insurance, anything like that. And everyone on the screen, we all have at least 10 years of experience in the financial services industry and intentionally focus on a variety of areas just to ensure as a team, we're able to meet the unique challenges of all of our participants. At this point, I will turn it back over to Chad. I'll pause here to see if we have any questions and kind of go from there.
Thank you, Keith. Thank you, Tina. So yeah, again, for everyone, just as a reminder, there is a Q&A box. We do have a couple of handfuls of questions up here, some really good ones, actually. So kind of excited to see the two of you address. But as a reminder for all of you in the Zoom menu, for all of you in the computer, there is a Q&A box. Please do continue typing in questions that come to mind, and our team will be happy to address them in the order they are received. With that, Tina and Keith, let me get to our first question in the Q&A box. So first, my company has a profit sharing plan and they contribute 15%. So first and foremost, hey guys, I think BFSG, we need to do that 15% contribution for employees. That is very generous. That is very fortunate for you. Most companies save nowhere near that amount for their employees. So really awesome for your company. So if that falls under that 20,500, can I add to my plan for the difference to get to 20,500? Can you kind of address that?
Yeah. Absolutely. So the amount that your employer is contributing doesn't have to have anything to do with the 20,500 threshold. That is how much you can contribute. And if you're over the age of 50, you can actually contribute up to 27,000. The amount that your employer contributes is on top of that. And you actually have the limit for how much can be put into your plan with your contributions, and your employer this year is 58,000. So there's a lot of leeway there. So that has nothing to do with how much you can contribute. You can certainly put it up to 20,500 into the plan.
Yep. So the short story, just save 20,500. Don't even think about your employer contribution. They're contributing in addition to that. Next question we have, and there's a couple on Roth, but are Roth earnings also tax-free? You mentioned that the contributions you make are tax-free when you take them out. What about the earnings on Roth contributions?
If the account is open for 5 years and you've attained age 59 and a half, everything comes out tax-free. There's a big difference to take note of between the Roth under the 401k umbrella versus the IRA. With the Roth under the 401k umbrella, at age 72, we talked a little bit about required minimum distributions. You would have to take money out of that, whereas the Roth IRA, that money can continue to grow tax-free and you never have to take it out if you don't need it. So yes, 5 years, age 59 and a half, everything comes out tax-free. So you're good.
And the important thing about what Keith just said is you can still save Roth in the 401k plan and get your 20,500 regardless of income. And when you get to age 72, if you don't want to take those RMDs, roll it to a Roth IRA at that time. So there's no reason not to save in the Roth in the 401k bucket in the meantime, or retirement plan bucket.
Correct.
So the next question also has to do with Roth. It says, if you were to max out the amount you contribute into the company sponsored retirement plan, can you also contribute to a separate Roth IRA? And if so, how much?
You can, depending on your income, and it's 6,000 if you're 50 or under 50, and it's 7,000 if you're over 50. But there are income restrictions in the Roth IRA, but you can do that if you qualify. That's why we mentioned this earlier with the Roth 401k, there are no income limitations. So,
yeah, I think that threshold starts right around $120,000, where you can start saving less in a Roth IRA, and then it increases. I think it maxes out around $140,000. You just can't even save in a Roth IRA at all. But none of that applies. You can make $2 million and still save in the Roth bucket inside of your employer retirement plan. So this is a hard one, I think, for a lot of people. If you're able to max out and save that 20,500 in a 401k plan, it's very likely you're getting close to those income thresholds where you might not be able to save an IRA just because of IRS rules. There are some workarounds, like a backdoor Roth, though, so loopholes that might be closing soon. So definitely work with your financial professional and accountant to see if that might be an option for you if you're just trying to get as much Roth savings plugged away as possible right now.
Yep.
Next question is, can you transfer a 401k or other similar type of retirement vehicle to a Roth IRA?
You can. However, if it's a pre-tax 401k, any money you take and convert over to the Roth is taxable income. So it's just like you earned it. So let's say you're earning $50,000 and the 401k is worth 50,000. Now your taxable income for that year is 100,000. So those are really important considerations to talk about with an advisor. We're here to help if you have any questions on that.
You guys, I think the important one is a pre-tax 401k would typically transfer to a pre-tax IRA.
Yep.
And any Roth dollars you have in your 401k would transfer to a Roth IRA, right? And it's really easy to facilitate that. Your advisor or financial institutions, wherever you set that IRA, will actually help you facilitate that from your individual retirement accounts. But be very careful if you're taking a pre-tax account and moving it to Roth. There's some huge implications. You want to work with your accountant before you do that. Next one is
Chad, the second part of that question was, your gains in Roth IRA tax-free. So I think we just need to make sure we confirm that that is correct.
That's correct. That's the same as one we just answered. Gains and earnings are the same. They are tax-free in a Roth account. Next question is, you guys mentioned a 50-30-20 rule. Will you please repeat that and re-explain it?
Your ultimate goal, if you're in a favorable position to be able to save 20% towards retirement, that would be the ultimate goal. 50% for your fixed expenses, and then the remainder for any discretionary spending. So like going out to dinner or whatever the case, going on vacation, where you have that flexibility to not spend that or spend more on that. So that's the rule there. But the main goal or objective is if you can sock away 20% into your retirement, that's the ultimate goal.
So guys, one clarification, and it's not the next question in Q&A, but I was going to clarify it because it's a quick and easy one. Around Roth, is it 5 years after you transfer to the IRA Roth?
So here's what I recommend if that's kind of the game plan. If you're 5 years or less away from retirement, opening up that Roth IRA outside of your employer sponsored plan, that gets that clock ticking. So that would work under that scenario. And I always recommend that folks do that if that's the intent, to roll it out and go into the Roth IRA to eliminate those required minimum distributions. So one more quick note on the Roth, when we're talking about gains, and Tina mentioned this and how it's taxed. In Roth IRA, because you've already paid taxes on the contributions, you always have access to that. So if you put $6,000 into a Roth IRA, it grows to $7,000 in a year. You need money a year from now, you can get to that $6,000 because you paid taxes without penalty or taxes. So it's very versatile.
Yeah, and I think the important one to remember that is 5 years from the date you open and fund the Roth account, right? Is really the answer to the question. It has nothing to do with when you transfer money. So you want to open that like Roth IRA, like as soon as possible, early on your career, like just put $1 in there, right? Or $100 and leave it in cash. Like it's like an extra savings account. You'll never touch it. And you know for sure it'll be open for at least 5 years. And when you roll that 401k or other retirement vehicle into it, this account's already been established, funded for more than 5 years. So before we leave that 20, 30, 50 rule, somebody has to clarifying item on it. Is that net or gross income you're talking about?
We're talking about gross income there. And it's all about the budgeting. I mean, we have a ton of resources and tools surrounding how to do that. And well, I don't have the link up right now, but that's something I can provide because the gross amount, when it goes into your retirement, that reduces your taxes, right? So then the other expenses, including discretionary and your fixed expenses, actually that portion would go out of net income.
I think the idea there, it's kind of a mix, depending on how you're saving, what vehicles you're using.
Yep.
Okay, next question. This is a loaded one. What happens to my 401k or other retirement account when I retire?
When you retire, your account will stay where it is until you do something with it. Or until you're 72, then you have to start taking out required minimum distributions. But when you retire, it'll stay there. You have the option of rolling it into an IRA or taking out, potentially taking out installment payments. Really depends on what your plan design is. But this is, that is the time when you really want to speak to someone, because the distribution strategy can be just as critical as the time, the years and years that you spent building up that 401k nest egg.
Absolutely.
So the short answer is nothing. What happens to your 401k when you retire? Nothing happens. Keep paying attention to it, keep managing it or working with a professional to manage it. At the end of the day, that account still exists, all your money's still there, and it's time to start making decisions on how to use it.
And it stays invested too, so that doesn't
Correct.
change either.
That's correct. So next question is, when can I start pulling money from my 401k or other retirement account?
Well, at 59 and a half, you can start taking money out. If your 401k plan has in-service withdrawals, you don't have to necessarily leave or terminate to take money out. But 59 and a half is usually the kind of the start date.
And so that there is some clarification, like for some governmental type of plans, it could still be age 65. They do, they're allowed to make it 59 and a half, but it was optional. So it is more as most plans out there do have the option for in-service withdrawals at age 59 and a half. Otherwise, it'll be when you retire or full retirement age, which is usually considered age 65 today. But that's as easy as checking your summary plan description that should be sent out once a year from your employer to you, and it will have those provisions in there to let you know when you're allowed to.
And really quickly, Chad, on that one, if you're state and local government, your employer, that's who you're working for. If you're in a 457 plan, there are no early withdrawal penalties. I just wanted to add that.
Yep. Next question is, so I have an IRA outside of my company's retirement plan. Should I transfer my IRA over to my current company retirement plan instead?
You have the flexibility to do that. There's complete portability in that regard. And it's, Tina kind of spoke to this. Is it a large plan? What are the fees? What are the investment options? So there are a lot of considerations in doing that, but you do have the flexibility to do that.
Yeah, it's something you got to look at. So not every plan allows rollovers in from IRAs. Most do, again, right? It's that every plan likes to have more assets. So if you want to bring an IRA, most plans will allow for that, but not all will. So again, you do need to check with your plan. The biggest one is, like Keith mentioned and Tina mentioned early on, is you got to just understand the difference in fees between the two, right? So if it's a really small plan, the fees might be pretty high. If it's a very large plan, they might be remarkably low, right? And then a lot of people say, well, there's no fees to have an IRA open. Why don't I just leave it in my IRA? There's no fees. Well, in your IRA, while you have to manage it yourself, you also might not have access to the same cheapness of mutual funds or index funds. Your retirement plans, because they're so big and because there's so many assets, typically qualify for even cheaper funds than you can invest in an IRA. So it might just be because your retirement plan has millions of dollars. They might pay half as much as you would pay for the exact same fund in your IRA because you don't have the same level of assets. So just something you want to talk with your professionals, look at the plan documents, and really understand the difference in fee structure with the IRA and retirement account. Next question is, when deciding between a traditional versus Roth retirement account, 401k or otherwise, what is the best way to determine if you will be taxed more or less when you retire? Loaded one.
Well, I think you have to get a crystal ball because that's the only way. There really isn't a great way to really look at it. Another way to kind of help with that is looking at your current tax situation. So if you're in a lower tax bracket, it might make sense to actually do the Roth right now because you're not going to have as much of a benefit of taking these pre-tax contributions. You don't have to necessarily lower your tax bracket, but it's a tough one. And I think the way we usually address this is just like you want to diversify a portfolio. We also like to see our clients and participants diversify their tax situation when they're ready to retire, because it does allow you more flexibility in your distribution strategy. So if you do have some pre-tax and some Roth dollars, then that can actually be very beneficial.
Because I think the idea, you want to have both pre-tax and Roth no matter what, right? Like it's to have only Roth assets, well, it sounds like a great idea. You actually would have paid more taxes, right? Because if you can at least have a little bit of pre-tax income, maybe it's just Social Security. If your taxable income is below the poverty level, and that's the only income that you had to report, you actually pay no taxes on it because you'd get all of it back in a refund. So some really important tax planning strategies to think about with that. Rule of thumb, early career, lower income, save Roth, later career, higher income, save pre-tax. When you're in the middle, talk with your accountant. I think Keith and I just did tax planning webinar just a couple of weeks ago. And one of the things that I love that he says all the time is, at the end of the day, we are in, as much as we think about taxes being high, especially for those of you living in California, New York, et cetera, we are in one of the lowest tax regimes we've ever been in the United States today. And a lot of these tax issues are going to all come back up in 2025. But right now, taxes are actually among the lowest rates they've ever been. So it's, I know people in the top income bracket paying 50% taxes that still save Roth because they just don't know what taxes are going to be down the road. And at the end of the day, even if you saved a ton of money, a lot of them say, I'd rather pay the taxes myself at 50% and give tax-free wealth to my heirs when I pass, right? So it's something you definitely want to talk, especially when you're in those middle income areas with your tax professionals and financial planner to figure out the best situation for you and your legacy down the road. Next question. If you are already age 60, what is the best aggressive way to save to maximize your benefits at age 70?
Aggressive way to see, and this kind of goes back to one of the slides we talked about, trying to get aggressive or make up for retirement savings. There's too much volatility in the stock market. I mean, there are some Social Security maximizing strategies that you can take advantage of. So if you're in a position, you go to retire, you're 60, whatever the case, and you don't need Social Security right away, your benefit increases by 8% each year. You defer Social Security beyond your full retirement age. At age 70, there's no reason to defer it any longer. So that's one strategy there, but I need a little more info.
Yeah, I think you're right. I think you're on the right track as far as trying to maximize maybe another retirement benefit versus the 10 years prior to retiring, trying to get too aggressive with your investments.
So next question for you two. This one, probably for Keith, thinking about, homes and interest rates. Would you recommend, aiming to pay down or pay off your home if you have the ability to do so by retirement, or is it better to invest some of that money in other things and maybe not be too concerned about paying off your home?
Two things here. Well, mortgage applications are at like a 22-year low. We went from below 3% to over 5.5% in a very short amount of time. So I would need to understand if you own the mortgage and it's cheap money, so your interest rate's 2 and change and whatever, maybe the opportunity cost there with the markets being down almost 20%, that might be an opportunity to invest more, but you can throw all the numbers out. And I say this during every, that's a huge key. You want that home paid for. If it's more of a peace of mind thing and you want it, no mortgage when you go to retire, that's all that matters right now. You can throw the numbers out, but from a financial perspective, with rates rising so quickly, it may make sense with the markets down to invest the money as opposed to pay the mortgage off, depending on what your interest rate is.
Yeah, it all goes back to interest rates, guys. I think the hard one is when you get to interest rates around 6 to 7%, right? Most experts from almost every financial institution out there are really looking at long-term returns in the stock markets of around 5 to 7%. So if your interest rate's in that same window for your mortgage, then you probably are equally as good off paying off the mortgage versus staying invested. If you're paying less than 3% of your mortgage, though, that's almost free money, right? So it's really hard. Like financially, it is the best decision to keep it invested and pay the mortgage off, as long as you can keep that free money. But again, like he said, there is nothing to be said for peace of mind, right? At some time, most people just want to get to retirement and not have to worry about that debt, right? Like, why do I want to pay $2,000 or $3,000 or $4,000 a month when I can just get rid of it and go to retirement and not even think about my house? So nothing can be said for peace of mind. That's more valuable than any market performance. Next question we have is if we have a side hustle, right, some type of consulting or other gig out there, can we contribute to a solo 401k in addition to our work 401k? And how might that impact that 20,500? Like, does it apply to both plans or combination or what?
Keith, I'm not actually sure about that one. My inclination is that you can contribute to both.
But still 20,500 still applies, and it is a combined contribution limit. So you could not contribute 20,500 to each plan. You could only contribute to one of them. There are some really tricky rules, though. This is where talking about the tax, like a CPA or a financial professional around different plan types that might allow you to save more in your own sole proprietorship. But if it's set up as a 401k plan and your employer is a 401k plan, you would not be able to contribute that $40,000. There are some tricky plan designs that might allow you to do it, though. So definitely it's worth talking with your CPA.
Yeah, there are other options out there. There are SEP IRAs. I mean, that's a perfect example of sitting down with a professional to figure that out.
Okay, what are your thoughts on precious metals in retirement accounts?
Well, the precious metal funds that I've looked at have not gotten a positive return in the last 10 years. But they certainly, if you were looking at them as potentially, some form of inflation hedge, they could play, a small role in the portfolio. But you'd have to look at your overall diversification. And again, it would really have to do with what your particular risk tolerance is. I can tell you from our perspective, we have maybe one or two plans that has a precious metals fund in their retirement plan. It's not very prevalent because of the volatility that they do experience.
I think the hard one there, guys, is if you do use it, right, it's not necessarily a bad idea, right? A lot of people like precious metals, like gold, et cetera. Unfortunately, for the last decade, they haven't panned out as well as being invested in the broader stock market. None of us have a crystal ball, right? That can change. They could be a great investment for the next 10 years, but nobody knows that. And anytime you're looking at one individual sector or industry like that, we just caution you to make it a relatively small position of your total portfolio. Keep a diversified account. Do not put all of your eggs in that one basket, because if you're right, it pays off huge dividends. If you're wrong, right, you end up with very little or no money. Next question is it 20% saving on post-tax saving or 20% on gross compensation? I think this goes back to that 50-30-20 rule.
Yeah. Can you address that?
The 20% saving would be on your gross income. So because what happens then at that point, the money comes out pre-tax, right? So that's a gross amount, the 20%.
Next question, and this is going back to another Roth question. I know, very popular, good topic, is if you had a Roth 401k for 5 years and are age 59 and a half or older, and then transfer the funds to a Roth IRA, does it need to be in the new account for 5 years for the earnings and withdrawals to be tax-free again? I think we addressed that, but can you do that one just in case again?
That does get a little messy. You want the Roth IRA open for 5 years that you're rolling over to. It gets working on a couple of things right now, but having the Roth, that's why I said, I would recommend if you're 5 years or less away from retirement and that's a game plan, have that Roth open, because that's when the clock starts. So just to err on the side of caution, that Roth should be open for 5 years.
Correct. And so the idea, and to answer the question directly, it does not, the 5-year clock does not start over when you roll it over. It's based on when that original IRA was established, right? So that's the trick there.
Yep.
Okay, next question. Any issues on retiring early at 50? Looking to go in 10 years? No CC, no loans, no car payments, mortgage, gone in 3 years. Should I be aggressive? What are your thoughts on that? First off, congratulations on being able to retire at 50 in the first place.
Oh, good. I think when you look at something like that, though, just remember that, Keith had mentioned this earlier, you're going to have a pretty long retirement window. So you'd really want to look at what your current savings are, even though you may not have a mortgage, car payments. Now, cars don't last forever. Houses don't, stay perfect forever. So, there can always be unexpected expenses. You'd really have to put a plan together to see how, if that would work.
And I think the biggie here, generally speaking, with traditional inflation, healthcare expenses are increasing almost 3 times the rate of historical inflation. So what's the plan there if you become injured? Because you're not eligible for Medicare until age 65. So that's a huge window, and it's very expensive to purchase private policies if you don't have one through work.
Yep. So write a financial plan, I think, is the biggest thing, right? You want to work with your accountant, work with your financial planner, and make sure that it is something that you can afford, just in case. Next question is back on Roth. This should be a quick one. Do you need to contribute for 5 years continuously?
Once it's funded, it's considered established. So no.
Yep. You could, like I said earlier, put $100 in your Roth account today, never touch it again. And 5 years later, it would have met that 5-year rule.
All about starting the clock. Yep.
Next question. I have invested in real estate for retirement. How has that worked in the last 40 years? I mean, what I can tell you is real estate's been a great investment for retirement.
Mhm.
Yes, I don't know that it's been better or worse than just investing in the stock market over time. I can tell you since the financial crisis, so many people scared about real estate. It was actually outperformed the S&P 500 since the global financial crisis in 2008, 2009. So it's been one of the best investments for the last decade plus. And going back for the last 40 years, your real estate's been great, but it really does depend on the type of real estate. I think a lot of people think about real estate like their home or having rental properties, but there are commercial REITs you can invest in, medical buildings and all these kind of things too. So, infrastructure REITs, like there's a lot of different ways to get exposure to real estate, and different types of real estate have not performed the same. So some have really underperformed, some have done really, really well. But most REITs are not investing in residential properties except for maybe apartment buildings too. So also, I think, Keith, tell me if I'm wrong, we almost never consider your primary residence an investment. That is where you are living. It does go as part of your assets and net worth and financial planning, but it is not an investment property typically.
100%. And to piggyback off the REIT conversation, if you are looking at real estate, you want to look at, generally speaking, publicly traded real estate investment trusts that are regulated versus going into the bank and buying these non-traded real estate investment trusts, which are very illiquid and expensive and not regulated like the publicly traded REITs. That's one of those products that you should really do a deep dive on before you consider doing anything, actually.
So next question, and again, this person said, they know we might have already answered it, but if you're over age 59 and a half, you take an allowable withdrawal from the employer's retirement account, 401k, 403b, et cetera. How is that withdrawal taxed? And is there an early withdrawal penalty? So the last part of that, there is no early withdrawal penalty because you have reached age 59 and a half. This person did mention their plan name, and I know for a fact this plan name does allow age 59 and a half in withdrawals. And then how is it taxed? Depends on if it's pre-tax or Roth. Right? If it's, go ahead, Keith.
I was just saying, if it's pre-tax, it's ordinary income, just like you earned it.
Right.
Yep.
Okay.
Okay, next question in here is, if I currently have an employer 401k and a separate Roth IRA, am I able to contribute the max 20,500 for the 401k as well as the 6,000 to the Roth IRA?
Yes, assuming your income is below that threshold Chad mentioned earlier.
That's correct. Yes, you can max out both for both retirement accounts. Next question is, what's the percentage you are taxed at withdrawal at age 62? Very similar to the last question we had. Basically, it will depend on your ordinary income is the answer there. So if it's Roth, you're not going to get taxed at all. If it's pre-tax, it depends on your ordinary income. So you got things like Social Security go into that, any other rental income you might have, plus whatever you withdraw. So it depends on how much you withdraw and what tax bracket that falls. Kind of think about your retirement account as your new employer in retirement, right? You used to get a paycheck and you were taxed on that paycheck and you did a tax return and you had to pay taxes to the IRS and the state based on that income. In retirement, your retirement account is your new employer. It's going to send you a check. You're going to report all of that and you're going to pay taxes on it just as if you were getting a paycheck. Just a couple questions left in here. Following up on a response about opening a Roth IRA account at least 5 years before retirement. I have a Roth IRA at one of the big brokerage houses, this one TD Ameritrade, but contributing pre-tax on my 457 plan, except for a couple pay periods last year on Roth. Will I be qualified? I think the answer there is yes, as long as that Roth IRA is there and you have it there for 5 years. If you're contributing pre-tax to your retirement account at the employer, and some of it's Roth, some's pre-tax, it's just important to understand that at retirement, when you want to move it to that IRA, only the Roth assets are going to move to that Roth IRA, unless you do a conversion that can have some pretty big tax consequences. The biggest piece of there is every dollar you contribute or you convert, it becomes taxable income that year. So you want to plan that out over time, work with your accountant and your financial professional to make sure you do that very strategically so you don't pay too much in taxes. Keith, anything to add?
No, you don't want any surprises there. Usually when we do these conversion strategies from pre-tax to Roth, it is a long multi-year strategy. We're looking at your tax situation in October to determine what makes sense. So what we want to do when you're doing these conversions is keep you in the tax bracket that you're in. So hypothetically, if you could have earned another $10,000, for example, in a given year, okay, we may consider converting $10,000 from the pre-tax to the Roth and not moving you up into that next bracket, if that makes sense.
And so that did actually address the next question in there is what were the implications I mentioned about converting pre-tax to Roth? That is the exact answer to that, is just be cognizant of the taxes you might pay. Next question is, are there yearly or transaction fees we should look out for which may drastically affect our savings? 100%. Tina, go for it.
Yeah, definitely. Especially if you're looking into, Roth IRA or IRA, working on brokerage accounts, there certainly can be transaction fees. There are fees within retirement plans. You're going to be paying expense ratios for the investment options that you have. There could be additional fees within retirement plans that are to pay for the administration and the operation of the plan. So you do receive on an annual basis, whether everyone reads them or not, there are annual fee disclosures. So they do outline all of the fees that are incurred within your retirement plans, but absolutely I wouldn't say they would drastically affect your savings, but it's important to understand what they are. Anything else, guys?
Yeah, I think it's understanding the differences in expenses is important, right? As Tina talked about expense ratios, you're paying for investment management, right? And you might be an index investor, really inexpensive, or an active investor, more expensive funds. But you can get all those in an IRA as well. The difference is really dependent on how big your organization is. Like I said earlier, in many cases, you would not be able to buy the exact same fund in your IRA that you could in your employer plan. Like the difference in fees can be pretty drastic. Like even an S&P 500 index fund, you might pay double in your IRA than you pay in your employer sponsored plan, just because your employer has $5 or $10 million in that one fund, and you might only have $1 million or less in that fund. And just the size and scale of assets dictate fees. So even though there might be a $20 or $25 distribution fee to take money out of your employer sponsored plan, and you might have some fees you're paying for the record keeper, like your Fidelity, Schwab, Prudential, wherever the record keeper is, wherever your assets are, there might be fees just to be in the plan. When you translate that into the difference in investment management expense, it might still make sense to be in the plan and pay those fees. You definitely want to do a cost analysis between the two different options. Right. Not to mention you might lose just resources, right? In your plan, you might have really easy tools to help invest. You move it out to an IRA. Now you need to invest it yourself or hire an advisor to manage it for you, which can cost a lot more money too. So if you're already working with an advisor, maybe it doesn't matter, but those are other cost considerations to keep in mind. Next question, guys, and this is our last two more questions now. They're both coming down to the 20, 30, 50 rule. Should you consider your employment contribution as part of that 20%, or should that be considered as a bonus?
No, that's absolutely a consideration as part of that for sure.
Next question. This is a California one on taxes, is related to that rule. How feasible is it to really save 20% of gross income when taxes in California already take away 50% of your gross income? That means you can only use 50% of your gross income to get to a savings that is 20% of your income.
Well, again,
be careful with that one. Dance, guys, dance.
I'll defer to Tina on this one. How about that?
What? I wouldn't defer to me on this one. I mean,
it's a rule of thumb because it's a rule of thumb. Your situation might be different. Your savings level, you might need to save a little less, a little more. It depends on how much you anticipate spending in retirement. There's another rule of thumb called the what is it? Rule of 110.
Yep.
You'll need 80% of your pre-retirement income to maintain your current standard of living. So there's a lot out there. This is just for more generic purposes, I think. And if you're not in a position, in an ideal world, yes, 20% would be great. But again, if your employer is matching any type of contribution you're making, that's the bare minimum you should be investing for.
Right. But that also goes toward the 20%.
Yes,
It does, guys. I think specific to the retirement accounts, I think most industry experts say that on average throughout your career, between your savings and your employer savings, you want to save plus or minus 15%. So if your employer gives you 5, you should save 10. Now that's your entire career. And the hard thing is, I think most people earlier in their career cannot afford, right? It's hard, especially those in California, New York, Boston, et cetera. It's expensive to live at, apartment, mortgage, et cetera. So you might start out only saving 3% or 6%, right? And eventually you ramp up and get to 10 or 12%. What that does mean is that early in your career, at some point you need to make that up to get to a constant average of 15%. So if early you save 6%, at some point you need to be saving 20% so that you average all that together. So I think that's probably the best rule of thumb we can think of, is specific to retirement savings. Try to target that 15% to 20% total savings rate.
Yep.
Cool. Everyone, that is the last question. Any closing remarks or key takeaways or points of advice, Keith or Tina, for the group today?
Thank you, everyone, for attending. Again, times are uncertain, markets are volatile. We're here as a resource for you always, but thank you so much. I really appreciate the time.
Yep. Thank you, everyone. Just, the key takeaways were really just, start small and be consistent and keep saving, and try not to react to what's going on in the markets. Thank you, everyone.
Thank you.
Thanks, everyone. We hope you all have a great afternoon.